To the markets now. Bob Iacchino of TraderOutlook.com is standing by at the CME. We're getting in some areas we haven't been in a while. Bob, do you expect a pause, or will we get through here?
Well, you know, when I was on your show in July, Joe, and I said that I thought equities would be up about 9 to 11% by the end of the year, and I was wrong. They're up 12.5 through yesterday. So just based on that same target, which I had at around 1247 or so in the S&P, I think we get a little bit of a pause. But this has definitely been, you know, from a return perspective, a successful year, and it's been what I think we're going to expect over the next 3 to 5 years as being called a really good year. I don't think we're going to see 21, 25, 18% consecutively, at least for the next 5 years or so.
Yeah, we had some great years in the 90s, Bob, where we did 30 plus for 3 years in a row. We haven't done anything for 10 years. Why don't we deserve that now?
Well, I don't know that it's a matter of deserve. You know, the volumes have been low for most of the year. They're obviously just ultra low in toward the end of the year. I'm looking for the trigger for me in terms of believing in the recovery and believing that equities can get us those high years. We're not going to see 30, but I think an 18 to 20% year, to me, the key is seeing dollar strength along with equity strength, the two going hand in hand. We saw a little bit of that yesterday. The dollar wasn't as weak as we've seen during equity rallies from the previous 6 months. So yesterday we saw a little bit of it. Today we're seeing the dollar pull back again, especially against Canadian dollar and a little bit against the yen. So I want to see those two go hand in hand again, where dollar strength means that U.S. assets are being purchased around the world and the equities are following suit. That's when I'm going to believe the whole story about the equities.
Yeah, because we haven't gone anywhere in 11 years on the S&P. So by deserve, I don't mean that we're good people necessarily and that good things should come to us, but then that means that where we were 11 years ago, that was the outlier. And then getting back to the standard deviation or regressing to the mean, then right now we're maybe with what earnings have done, because earnings at many of these companies have doubled or tripled, in the multiple has come down to where we're at the same level where we were 11 years ago. But so that's more of a fair value now. We're not undervalued.
Right.
Really?
Right, and I think the earnings are going to continue to be strong in Q1 especially. Everybody's expecting decent retail sales over the holidays. I think they're going to be very good. But the issue is volume again, and the issue is, have we lost that investor that got hurt so bad in 2007, 2008, at the beginning of 2009? Have we lost that investor for good? Do we see unemployment rates drop and some of those long-only mutual funds start to get inflows again as opposed to outflows to get that natural bias up
Bob,
again?
considering that usually the bag holders don't get in until the end usually anyway when the market's already made a move, so it doesn't make sense that you need everybody in at the beginning of a move to have the volume to make the move go higher, does it?
Well, I don't know.
It kind of melts up, doesn't it? The market has a way of...
Here's the issue.
Tell me, because I don't understand.
To me, the issue is this. Everybody cuts the market off at the end of December, right? Let's say we ended right here. We did 12.5% this year. Now, the beginning of January, we're at 0 in theory, right? But in order for the market to continue up, the earnings come strong, the traders continue to have a long bias, and then the bag holders come in at the end, and that's what pushes it up. Right. And that's what, it's funny, you were talking to your earlier guest about why would somebody go into 4% treasuries if we're going to get a 20% yield on the S&P. Well, that's exactly why, because they don't believe that 25% can go to 35%. So they start to go into much more safer assets from a standpoint of risk-adjusted returns. Everybody forgets about risk-adjusted returns. The average investor, they just think, oh, that's only 4%. I don't get anything out of that. But when you're up 20%, and the expectation is that it can go up 5 or down 15, you enjoy being in a 4% with those gains.
But if the multiple is, say, 15 or 16 right now, and you, what do you think? S&P profits go up how much? 10 or 12%?
I'm looking at about 1374 in 2011,
so either,
if we can control the EU debt crisis.
So either multiples contract or you get 13%.
Well, again, I mean, I don't think that's necessarily... I don't think that's necessarily baked in the cake. For me, again, everything is about duration on trading. I'm a trader. I'm not necessarily an investor when I'm talking on this show. Yeah. So for me, I'm happy to change my mind next week. That isn't necessarily satisfactory to the viewer because I might not be on next week to tell you, hey, I've changed my mind. But where it stands right now, the Fed just renewed its swap lines with the EU. So it seems like the EU is still going to continue to get the Fed support. If they can contain what's going on in Europe and earnings are strong, I don't see any issue with 1374 at all next year.
Do you think that they finish QE2? Do they go on to QE3, or is that it?
I think that's it, to be honest.
QE2?
Yeah, I do think that's it. I think we're done.
And rates can go up even with QE2. That may be what they were trying to do in the first place.
Right, and again, that's when the dollar strength goes, when the dollar strength comes in. If they raise rate, we get dollar strength, and if the S&P doesn't collapse on that, everybody's going to pile in. I think the U.S. has a good chance of being the story next year.
Okay, great. All right, Bob. Thank you.